Welcome back to the deep dive. Today we're doing something a little different. We're not just looking at a chart. We're going to dissect the anatomy of a trap.
Yeah, this one was pretty brutal.
We're looking at a micro S&P 500 session where the market set up what looked like a perfect blue sky breakout and then just absolutely punished anyone who bought into it.
It really did. And honestly, it's a masterclass in why trading a pattern without understanding the context, well, that's how accounts get blown up.
The notes call it the retail trap. It started right at the open. The S&P is just banging its head against all-time highs. It looks like it wants to rip higher. But you've got this note here in red ink, critical divergence.
That's it. That was the clue that I think almost everyone missed. If you were only looking at the S&P, you saw strength. But the Dow, it was opening below its key selling zone. It was already weak.
So the S&P is trying to fly, but the Dow is like an anchor tied to its ankle.
That's a perfect analogy, and that discrepancy, it creates what we call a weak breakout. The S&P pushed past the high, sure, but the math just didn't add up.
The math? What do you mean?
We look at something called the volatility factor, or VF. Think of it as the engine's power. On this day, based on the recent volatility, you needed a full 6-point move to prove that breakout had real conviction.
And we only got, what, like 3 or 4 points?
Barely even that. It just stalled. So you have all these traders buying the breakout because they see a green candle, but the volatility math is just screaming, fake out! The engine had no gas.
Okay, so that brings us to the actual entry. We get a double top right at that all-time high. Now, double top is pretty basic stuff, right? Why was this one so special?
It was the confluence. You rarely want to take a trade on just one signal. Here we had 3 different layers, all overlapped.
3 layers. Okay, break it down.
1, major resistance. You're at the all-time high. Can't get more major than that. 2, you get that bearish double top pattern. And 3, a breakdown below SD1.
SD1, that's the first standard deviation level?
Exactly. It's a statistical boundary. So when price tries to break out, fails, and then crashes back under that SD1 level, the probability of a reversal just shoots way up. That breakdown was the green light to go short.
So you're short. But then comes the really scary part. The notes talk about the daily VWAP, the volume-weighted average price. Usually when price hits that for the first time, it bounces hard.
Oh, yeah. The classic V-shaped recovery. It terrifies anyone who's short.
So why didn't they just cash out, holding through an untested VWAP? That feels, I don't know, greedy,
Yeah.
even reckless.
It all comes back to the pre-market work. The probability model for that day was calling for a large range day with like an 83% confidence. So the stats were saying, hey, we have more room to fall.
And the Dow?
The Dow was already crashing, so we were really just betting on the S&P playing catch-up to its bigger, heavier brother.
But looking at the trade log here, they almost messed it up. It looks like someone hit the panic button.
Ugh, the break-even mistake. As soon as the trade went a little bit into profit, the trader moved their stop loss right to break even, right on that SD1 entry point.
Which on the surface feels like responsible risk management, right? Can't lose money now.
It feels safe, but it's actually a trap. Markets breathe. They have to retest levels. If you put your stop right on the breakout point, you are just begging to get wicked out right before the real move happens.
So they caught the mistake in time.
Just in time.
Yeah.
They pulled the stop back, topped it behind the swing VWAP, and just gave the trade some oxygen. And what happened? The market bounced, missed their stop by a few ticks, and then the floor just fell out.
And they actually added to the position on the way down.
The art of the add-on. But notice where they added. The first try was too aggressive, near support, and it failed. But the second one worked because they waited for the price to pull back to that old SD1 level, confirm it was resistance now, then they added more size.
Smart. They wrote it all the way down to SD2 and the range projection target. Huge win. But there's one final red flag in the notes, a third attempt to add size at the very bottom.
Yep, pure greed. The major targets were hit, the move was pretty much over, and they tried to squeeze one last dropout. It was an immediate stop out.
The market doesn't give infinite gifts.
It never does. You got to know when the party's over.
So if we boil this all down, we had a divergence, a volatility failure, and a statistical breakdown.
And it just proves that context is king. A double top is just a squiggly line on a chart, unless it happens at a major statistical extreme.
Which leaves us with a tough question for you to think about. If a perfect trade requires resistance, a pattern, and the statistics to all align, how many trades are you taking right now that are just good enough and actually just noise? Thanks for listening to this deep dive.